All right, welcome everyone. It's Mike Curtis here, and I got a special guest, Kyle, who is our software engineer and just tech genius that's always working behind the scenes here at Trader's Edge. And we wanted to throw together a quick video for any of you that are using the new broker Robinhood or thinking about potentially using Robinhood, because I know that's kind of been the popular broker, and the app's gotten a ton of downloads, especially throughout this last year. So we wanted to show you, if you are in Robinhood, some of the option levels that you need to make sure you have so you can trade the money press. And then we're actually going to walk through. Kyle's been kind enough to open up his account. He's going to throw on this money press trade right in front of us today so you can see exactly how to place that order. So Kyle, why don't you show them in the account details what option level they need to have to trade the money press, because it's a little different from broker to broker, whether you're Schwab or Fidelity or Robinhood. They kind of classify these trading levels a little bit differently, and you went in, you're able to get that set up the right way. So could you walk everyone through exactly what level and where they can check that in their Robinhood broker?
Absolutely. Yeah, this was a fun little experiment that Mike and I wanted to do. And so obviously I'm on the desktop, but I actually did the options level 3 through the app on my phone, but it's going to be very similar. So just know you don't have to do it through the desktop. You can do it through the app as well. But for the sake of this video, what you're going to do is on the app or in here, you're going to come to account, and then you're going to come down to settings. And then what you're going to do is on the left-hand side here, you're going to come to options trading. And then I've already got level 3, but you'll have the option here under this section to click a button. And what it's going to do is it's just going to ask you questions. It's going to confirm you know what you're doing. Basically, you just check boxes, and I think there might be a few short answers. They just want to make sure that you know what you're doing, to get in trouble.
Perfect. And if you at home are setting this up and you run into any questions, reach out to us at the crew at tradersedgenetwork.com. You can email that if there's some questions that you want to make sure you get right. We can try to give you a little guidance, or just Google it. You probably find the answer there too. But the important one at the bottom of this list for level 3, yeah, we're going to buy calls and puts. Yeah, you might do some covered calls. You're going to, at some point, maybe you want to exercise an option, probably not very likely, but the important one is that very bottom one on the list, the buying and selling spreads, because a money press technically is what's called a diagonal spread. It is an option spread where we're selling and buying at the same time. So that's the important one. It looks like level 3 is the one that encompasses that buying and selling spreads. So this is awesome, Kyle. So let's dive in. Now that we kind of showed that element, let's jump in and show them how to actually place a money press trade here inside Robinhood. So we actually just kicked off our small account mastery series last week, and this was a trade that Preston started in that small account mastery series. So it's on Qualcomm, ticker symbol is QCOM, and Kyle was a little bit late on jumping into this, so we're going to start it. Preston made his adjustments today. It's expiration Friday. And so since Preston is making that adjustment, what we can do is just start this trade brand new following the new strikes that he's adjusted to for next week. So here's Qualcomm. So Kyle, what we'll want to do is, oh, that's cool. So just right there, trade Qualcomm options. And I've never used Robinhood. This is all kind of new to me. So you pop up that trade option screen right here. Now, the money press is 2 sides of the trade. We're going to sell a weekly, and then we're going to buy a weekly. So you can start, because I think this is going to put it all together on the same order form, right, Kyle? The one you walked me through.
It'll build it right
this video. So.
Yep.
Perfect.
Correct.
So we can start with either one. Why don't we start with the weekly? So we're going to sell the weekly option, and that's the 134 strike put. You can see you just click sell, you go to put, it changes the color, so you know you're dealing with puts. And it's going to be the 134 strike. And we want to make sure, since we're selling next week's, that we get that expiration right. So in this example here, we're using the May 21. That's a week from today. That's a week out. So when you're watching this video, it's obviously not going to be May 14th, most likely. So make sure you're looking at getting that right expiration date. So all you have to do is make sure you get the sell, the put. We're looking at the weekly option, and this is the first leg of the money press, and this is the 134 strike. So you just give that little plus sign a click, and it throws it over there showing that you're building that order. So this is great. So it's showing credit because we're selling, that money is coming into us. Someone is buying that from us as we're the sellers. They're paying us that $3.80. It shows right there. That's a credit to our account. Now, the second leg of this is buying the protective put, which is going to be the August 125 put. So this is going to be out in time. We're buying this about 4 months out, right? May, June, July, August. Oh, sorry, it's about 3 months out from where we are right now. So usually we're buying that put protection 3, 4, 5 months out in time. So again, we're doing the buy on this one. We've got to make sure it's a put. And then we've got the August expiration. So you just fill in some of those simple details. And then Preston on this is choosing the 125 strike price. So you find that 125 right there. I'm guessing we just do that little click of the plus button again. And bingo. So this, because it's a, we are now the $6.20. We're bringing in the $3.80 that you can see the price is adjusting in real time up there. And what that means is more money is going out than coming in. So initially this is going to be a debit to our account, which is common. That's how any money press is going to look when you first start it up. So that total cost is $2.35. Now remember, that's per share, and a contract represents 100 shares. So that's actually $235. So that's cool. It gives you a little risk graph down there, shows you where we're going to make money. And don't put too much weight in that risk graph, because we're going to adjust it a week from now, and that all changes. And it's this diagonal spread, the way we manage it week to week, that risk graph is constantly changing. If you're a more advanced option trader, know what that is. If you have no idea what a risk graph is, just ignore that. All right, Kyle. So next step here, we just click on that continue. Is that where we go next?
Yeah.
Perfect.
Remind me, is it 2 contracts he did or 1?
Let's just do the 1 for now, and I'll go back and check what he did on that small account. I think he did 2, but he was like, it was probably a little too aggressive for the small account. So why don't we just stick with 1 here? So just to walk through what everyone's seeing. So the number of contracts is that top number. The limit price is what we're saying, hey, we're making an offer, we want to get filled at this price, or don't take the trade. So it's kind of like when you make an offer on a home, you're saying, I want to pay this price, or we don't have a deal. That's what a limit order is. And then that expires, that just means it's good for the day. Or you can say, hey, let this order sit tomorrow, the next day, next week, until the option order fills. We usually just leave that good for the day, because so much can change from week to week. So awesome, Kyle. So let's send that through the review order.
So it just gives you one last check to make sure you've got everything correct here. All right, we good, Mike?
Perfect. Recording a webinar. It looks like it's taking a second to load, or maybe that's just on my end. Kyle and I are doing this from different cities. That's the beauty of technology. So this is perfect. So just to walk through what this order is showing. Oh, boom, filled like that. So there was the total cost and collateral. So when you start a money press, there's 2 different costs. There's that debit, right? We're paying more for that 3 or 4 or 5 month output than what we're bringing in week 1. So that's the total cost. That's the debit that we're actually paying to get the option trades going. But then the broker, and Robinhood calls it collateral. Some brokers are going to call it like a margin requirement. But what we did is we're selling that 134 put, and then we're buying the 125 put. And so there's that $9 spread between our strike prices. And what that's really saying is we might have to buy stock at $134 a share. Now, we're going to roll this, and that's probably not going to happen, but that's what the position could mean. And so the broker just needs to cover their bases. So they're saying, hey, if you have to buy it at 134 because you sold that 134 strike put, but then you bought your protection. So you now bought the 125 put. That gives you the right to now sell the stock to someone else. So in the worst case scenario, the broker has to cover all their bases. Let's say Qualcomm, there's an Enron type scandal and Qualcomm opens up tomorrow at, 0. Never going to happen. Big, profitable, successful company. But that is technically a scenario, even though it's very, 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 very unlikely. I would say impossible. The broker needs to cover that downside risk. And so what they do is they just hold that $900 in buying power in your, it's still there. It didn't get invested in anything really. It's just being held as part of this Qualcomm trade. So collateral is a good way to look at it. You just kind of have to put that money up that they're just going to hold. So that's the long and short of it there. To get that played trace is pretty simple, a few clicks. Hopefully that makes sense on where the costs are coming from and how to get one of those trades started. So Kyle, thanks so much for helping us walk through this video today.
Yeah, absolutely.
Okay, hopefully that was helpful, and good luck with your trading out there.